Venkatesh Sanjeevi is the co-manager of the Pictet-Indian Equities Fund and now joins in on the show. Thank you so much for taking time out. How worried are you about the kind of slowdown that we're seeing that's really playing out? Because all of the sectors or the economic policies, there really seems to be a craft help from corporate India and a lot hinging on what the government could potentially do to alleviate these concerns.
Hello. Hi, good afternoon. Yes, indeed, this slowdown is it's been quite complex. Just the speed and the intensity with the slowdown was probably unprecedented. I mean, same time last year, we were talking about the economy doing quite well across different parameters, but today we are at a different position right now. And in terms of the intensity, when we talk to people from different parts of the economy, like the real estate consultants or maybe the auto sector, they say that they haven't seen this sort of slowdown in years, maybe even decades. So it's been a quite complex slowdown, but you can't say that it's entirely unsurprising. To give a few examples, let's say the commercial vehicle space. Right? The commercial vehicles are inherently cyclical industry. Right? India saw a good cycle for about 4 years. And you could argue that a cyclical slowdown was due at some point of time. Maybe the axle load norms which were changed last year sort of speeded up the slowdown because the capacity of the system went up overnight. Similarly, when we talk about the NBFC space, you would have looked at the space after demonetization in 2016. The entire space grew very rapidly. And the growth was not very well planned. Some players were taking short-term loans, short-term borrowings to lend long-term. The asset liability wasn't matched, and again, you could argue that that sort of growth is probably not sustainable. But what's complexing is the slowdown in staples. I mean, recently we heard about companies like Parle saying that the 5 rupee biscuit is slowing down. That seems a bit more strange and complex in this particular scenario. Our own view is that this slowdown is cyclical and more temporary in most aspects. There is some sort of correction which needs to go through in parts of the economy where excesses were built, and that takes time. And there are a lot of the reforms which took place over the last few years take time to actually get digested. So the slowdown is more, in our view, it's cyclical in nature, it's temporary, and we are still positive on the long-term outlook for India. The country offers a number of good quality companies and good quality management, and which we're happy to bet for the long term.
Sure. Okay. I just want to come back to really what more you'd like to see in terms of signals from the government, because we've had the entire furor over the FPI tax dampening mood, a huge outflow from FIs, when it comes to the Indian markets since the budget. While the government seems to have taken note, and we've heard both the finance minister and the prime minister talk about taking this into account, we haven't yet seen any action on ground. What would you like to see, Venkatesh? And do you feel perhaps that apart from these tax concerns, there are other reforms as well that would get things going right now?
Yeah, you touched upon 2 or 3 aspects. One, let's take it separately. One on the reform side, right? I mean, over the last 5 years, we've seen a number of reforms this government has done. Some of it is complete and some of it is work in progress. So we would like the ones which are work in progress to continue and reach its logical conclusion. One area where reform is eagerly awaited is on the direct tax side. The direct tax code isn't due anytime soon, so we look for that. I mean, right now India has got a massive opportunity to participate in the global manufacturing supply chain with the US-China sort of issues happening. There are companies globally looking to look for alternate supply manufacturing arrangements outside China, and that's where India can actually step up and offer something, offer scale, offer size, which countries like Vietnam or Malaysia can't probably offer. So for this to happen, the government needs to be more proactive. Maybe ease the land and labor reforms. And so we'd like to see government take steps on these sides. On the second issue we raised on the taxation side, frankly, we don't know what's the actual stance of the government. The increase in taxation, was it an intended consequence, or was it unintended because they were looking to increase taxes on the rich and super rich? So it will be nice to get us some sort of clarity from the government on what exactly is the stance on this particular side. So I think on both long-term reforms and shorter-term measures, there are a few things which the government has already done, and we would like to see some more work on that.
Okay. Would you like to also see fiscal stimulus, Venkatesh? Because there's been a huge debate even today, given some of the comments coming in from the chief economic advisor, putting the onus on the private sector, that fiscal stimulus is also required and is critical at this juncture to kickstart things. What do you feel, versus the government's argument of maintaining the fiscal deficit, ratio, of course, and so what do you feel on that front?
Well, fiscal stimulus, for it to happen, the government needs to have room in the budget, which unfortunately is not the case, right? And I think the government has maintained its path of fiscal consolidation, and not just this year, but it's over the last 2 or 3 years. So I think, and the government has also mentioned that a lot of heavy lifting would be done by the central bank, where they could possibly cut the rates if inflation remains under control. So I would keep my hopes on fiscal stimulus on the lower side, especially given the budget constraints. Although it could be a short-term fix to solve the near-term issues. A bigger question would be what's the longer-term view and whether the structural reform process continues or not. So I think that's more important than the short-term fix.
As we speak, we've broken the previous low of 10,782 on the index. We're down a good sub 170 points actually for the Nifty. 10,746 is where we're currently at. And let me not even go close to mentioning what's happening with the broader markets. A 300-point fall for the mid-cap index. Small caps down 142 points. That equates to roughly about over 2.5%. But the fact of the matter, and just getting back to the conversation right now, Venkatesh, is that all this is very well, but look what's happening to equity markets. And this is just the individual index level. I'm not even talking about individual pain points. The fact is that just a very handful of those blue chips, the Nestle's, Unilevers, Asian Paints and HDFC banks of the world are withstanding this fall in the market right now, and rest all of it is bleeding. As an equity investor, what do you do? What is the strategy to try and wade through this and cope with this sell-off?
Yeah, exactly. I mean, on the headline multiples, the index is trading about 17 times or 16 times 1 year forward, which is roughly in line with long-term averages. But the headline really does mask a lot of details. Like you mentioned, a few stocks are trading at extremely rich valuations, while a few other stocks are trading at pretty depressed valuation. Some of the government-owned names like ONGC, NTPC are trading at multi-year low valuations. So we look at this as an opportunity for active investors, active equity investors. Mispricings do come up, and this is a chance for us to align a portfolio to where we think mispricing is significant. And once some of these cyclical pressures in the economy normalizes, I think some of the stocks which are mispriced could give fantastic returns. So we are on the lookout for opportunities like this. I mean, continuously looking at different parts of the market. In fact, incrementally over the last few weeks, some of our time has gone towards looking at consumer discretionary sector, the automobile sector, where stocks have corrected quite a bit. I'm not saying that stocks have become cheap now, but it's come to more interesting levels where a good scenario, if the cyclical upturn comes in a couple of years, good quality companies which have a moat around the business model could have earnings which are much more than current levels. So I think opportunities are rising there.
Point when there's nervousness that we may actually see a further fall and further weakness, and this is talking about the index once again, because the broader markets, of course, one could say are in clear bear territory right now and have been for a while. You say you're looking for opportunities, but what's the kind of return potential at this point, even in the long term, even if you're looking from an annual point of view, and where do you see fair valuation currently for the index?
It's very difficult to give a sort of index return estimate and things like that. I mean, we believe we are stock pickers, and index, the headline number could be very different from stocks which are different. I think I would refrain from giving a return sort of an estimate going forward. But compared to, let's say, a year ago or maybe a year and a half ago, where most stocks were building in a very blue sky scenario, where was building in high growth and high multiples. Today, some of it has corrected, and if the scenario of cyclical downturn does change in a couple of years, which is the base case, the base case is not that India is structurally going to grow slower. This is a cyclical downturn which will take time to correct, and once the correction happens and earnings pick up, I think a lot of companies can give much better profit growth going forward.
Okay.
So, just to stretch that point going forward, can you give us a sense as to what kind of earnings growth you're expecting? Do you think that after the kind of marked slowdown we've witnessed, that, for select sectors on account of good monsoon, festive season, etc., that we can see an incremental pickup overall when it comes to earnings?
It's it's very different for different sectors. The private sector banks are probably in a better position now in terms of visibility of earnings, given that some of them have lower issues on asset quality, and they continue to gain market share in the loan segment in the overall market. So I think the visibility of earnings for private sector banks continues pretty strong as it used to be. For the consumer discretionary sectors, has seen a slew of earnings cuts over the last few weeks, but there's still a bit of optimism which is built in for the second half. There is a base effect which will come in favor as we go ahead, but ultimately you need the economy also to pick up, and if the optimism is not reflected in numbers, there could be further earnings downgrades in the near term. But again, let me come back to my point that it's very difficult to predict earnings on a near-term or short-term basis. The volatility could be there based on how things move around. But we would rather look to look beyond the next few months and see where companies can deliver good earnings growth over the next 3 or 4 years period.
Venkatesh, I have a two-part question for you. One, if you could be frank with me and tell me really what the sense is on India right now, post, of course, some of the tax concerns, given the new government's mandate, just as an investment opportunity versus other emerging markets at this point of time, has the interest waned a bit? Is it as ripe as ever? How would you describe it? And secondly, we are also tracking global dynamics with a lot of interest, even from an India perspective, to see the kind of impact it will have on money markets. Just to get a perspective from you on the likely impact that we might see here, given that there's still a lot of uncertainty on what may go down with regards to the trade wars or the Fed, and on that front.
Yeah. So let me take the first question on the interest on India. So you would have seen the last couple of months there have been some foreign outflows. Some people call this massive outflows, but to take a step back, for the year 2019, the calendar year, we're still a fairly decent positive inflows from the foreign investors. So the last 2 months outflows could be because of various reasons. I mean, the valuations probably are quite full after the elections. Maybe there are a set of investors who worry about the taxation change. So I think it's not one broad brush which can paint the reasons for us across all investors. There are multiple concerns which have come out in terms of the economy slowing down, and maybe some investors have got worried about that, and hence moved money outside India to other emerging market countries. But to speak from our perspective, from our Pictet-India Fund, we have not seen any outflows, and we are remaining invested. And my colleagues who manage the Asia Fund also remain overweight on India throughout this period. So from our perspective, there is, we continue to look for stock-specific opportunities, and we look for this slowdown as a chance to buy some of these good companies at much better valuations.
Venkatesh, yeah, please go ahead.
Now, I was going to move to your second question, if you can.
Yeah, sure, carry on.
Sorry, your second question was more on the global impact of what's happening around the world. So, I mean, there are again different elements which can impact flow of money into India. But to name one or two, it's obviously what's happening with the Fed rate and what's happening with the expectation of the Fed rate cuts. And secondly, a general global risk on or risk off environment. Over the last few weeks, there's been a certain risk off, as you would have noticed, money moving towards safer assets like gold or maybe the government securities. Most emerging markets, not just India, most emerging markets saw flows in August. So a global risk off environment, of course, would be a bad scenario for most emerging market assets.
Venkatesh, just wanted to figure out, because we're already brittle, what can break us is if something awry had to happen with the global markets. And just looking at the way the yield curve has been moving, that really is the big fear as to when is the big two, UK and US, going to go down in recession. Is that a legit worry, you think?
It definitely is a worry for overall sentiments. It's a worry for market, for money to flow out. But ultimately it has to be reflected in the earnings and growth of companies. When you look at the Indian market and Indian companies, a large part of the market is reasonably insulated from what's happening in the US. I mean, it's a large domestic-driven economy. You could argue that the tech sector in India has got a fair amount of exposure to what's happening in the US, and that could call for some sort of downgrades on the tech earnings because US itself is a large contributor to tech earnings. But still, a good part of the Indian economy should remain insulated from that, and ultimately the earnings of these companies shouldn't be impacted too much.
Venkatesh, thank you so much for joining us. Great having you with us here on ET Now and to get your perspective, particularly at a time when investors are incredibly nervous about the situation here. So, hearing that validation from you with regard to your view on the Indian markets is great to have today, especially. And clear message coming in. It's a cyclical churn, and the long-term earnings scenario is still intact. Looking at consumer discretionary, looking at auto stocks at these valuations. That's the word coming in from Venkatesh Sanjeevi.